a quiet period on the trust, so we've had very little by way of portfolio turnover. The reason for that essentially is that we believe and have believed for some time that the companies in the portfolio are materially underpriced. And as a result of that, even despite the volatility we saw at various stages within the market last year, that hasn't, in our minds, warranted a change in the portfolio holdings. The trust has enjoyed a good period. For calendar 2022 and into 2023, the trust has materially outperformed the index, the FTSE All-Share Index, building on the gains that it saw in 2021. So it's been a good period. But having said that, it hasn't been a completely smooth ride because sentiment during the course of 2022 did wax and wane quite significantly. You'll remember that last year started pretty strongly up until the point that Russia invaded Ukraine. We then went through a period of nervousness in the spring as markets tried to digest the implications of the Ukraine invasion. Sentiment then recovered somewhat before, of course, in the UK we saw the comings and goings of the Liz Truss government and the volatility that created. Into the back end of last year, so I'm really talking about sort of November and December, then carrying on into this year, sentiment seems to have improved quite dramatically again, and investors generally taking the view that actually the world is not quite as bad a place as perhaps they might have feared in September and October. And the trust has a high exposure to what we call cyclical companies, so companies whose fortunes are very much driven by the state of the economy. The reason the trust is invested in cyclical companies is because that is where we have felt that the undervaluation resides in the stock market. And so as confidence has improved, markets have regained their poise, and the trust has disproportionately benefited from the improvement in sentiment. For some time, observed that there's a significant discount applied to UK listed assets, really by virtue of the fact, that they're, simply by virtue of the fact that they're listed in the UK. The UK stock market generally has been out of favour for some time now. We can't know precisely why that is. Suffice to say that obviously Brexit will have the negative sentiment surrounding Brexit will have had something to do with it. And I think also a desire by UK-based investors in the last few years to reduce what they might see as their home bias, so reduce UK equities and put the money into overseas assets. But whatever the reason, the juncture we're at today is that UK listed companies stand on some pretty significant discounts to their overseas competitors. I'll give two examples. So if we look in the energy sector, we've for some time held large positions in the energy sector, believing that the companies are very underpriced. So take a company like Shell. Shell, as you know, is listed in the UK. The energy companies generally have been obviously enjoying the benefit of high oil and gas prices, obviously exacerbated by the events in Ukraine at the beginning of last year. And as a result, the companies are obviously at this juncture extremely profitable. But that, in our view, despite the fact that the share prices have done relatively well, it hasn't resulted in a re-rating of the company's shares. So you take a company like Shell, it's on a price-earnings ratio of around 6 times for the current year, so that's calendar 2023. You look across the pond, you go to a company like Exxon in the US, that peak price earnings ratio would be around 10 times. So there's an example of where a very similar company, Exxon is very similar to Shell, stands as a significant premium to the valuation applied to Shell simply by virtue of the fact that it's not listed in the UK. If you look at the banking sector, banking sector is another example. Take a company like Barclays Bank. But so Barclays obviously has a retail banking business. It also has an investment banking business. Barclays Investment Bank is the largest investment bank outside the US, so it's got a pretty good market position. Again, these companies, the banking sector generally has been very profitable in the last 12 months as a result of they've been helped by rising interest rates. And obviously, as interest rates rise, so net interest margins increase, and that's been helpful for the company's profitability. But nevertheless, again, the shares of Barclays have not been significantly re-rated. So the company's share price today is around £1.80p. The company's just reported around 30p of earnings, so it's on a historic PE of around 6 times. If you look at it on a price to book value terms, it's on about 0.6 times its book value. Again, compare that to its US competitors. Those companies are trading on at least 1 times book value, so a significant premium, but something more often 1.5 to 2 times book value. So again, a significant valuation discount according to the company by virtue of the fact that it's listed in the UK. And what this means, of course, is that we have long believed, and there's a load of empirical evidence to demonstrate it, is that starting valuation is the best predictor of future investment return. So the lower the starting of the valuation, the better the subsequent investment return generally. And so what we think is that yes, it's we recognise that the UK market is very out of favour, but we believe that that is throwing up significant bargains, and that those who are those remain invested in the UK will reap significant benefits as a result, as the shares that they hold deliver a higher level of investment return. We are not thematic investors or even macroeconomic investors, simply for the reason that predicting the outlook for the UK or any economy is nigh on impossible. Events move in an extremely unpredictable way. No one would have predicted COVID. No one would have predicted the Ukraine war. 2 events which obviously have shaped the markets very dramatically in the last 3 years. The way that we think about it is we try to identify individual companies which, by virtue of their franchises and their market positions, are able to grow their profits over time, not each and every year necessarily, but over time, where those companies are conservatively financed, so the balance sheets are strong. And what that means is that when you've got a strong balance sheet, is that the company can withstand an unexpected economic downturn, such as the one we saw at the time of the pandemic. And most importantly, we look for companies where, for one reason or another, they might be out of favour with the market or other investors, and therefore they stand at a low starting valuation. Because if you've got a company that can grow its profits over time, is relatively resilient to economic shocks because of the strength of its finances, and it starts at a low valuation, it means that over time, the full benefit of that profit growth will be reflected in a rising share price. So those very simply are the 3 things that we look for in individual companies, and we try to put together a group of companies in a portfolio which is sensibly diversified. So when you ask what our outlook is, that's kind of a difficult question for us to answer. As I say, we very much stick to the individual companies.